Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. Best way to do that is to follow me on X at Focused Compound. If you want to get access to investment write-ups from Geoff, going all the way back to 2005, if you're watching on the screen right now, you can go to focuscompounding.com, click that blog spot on the header, and you can get access to all those write-ups. Look at this, December 2005. If you're interested in learning about our money management services, you can reach out to me at andrew@focuscompounding.com, and we will start that conversation. So today's podcast, Geoff, we have a lot of stuff to talk about. And, we talked about Paramount a few podcasts ago, right?
Mm-hmm.
And I made the claim. I said, I don't think this is the end of the story. I think somebody's going to come scoop in. Right. And sure enough, a few days ago, this ad, it looks like it was updated 2 days ago, August 21st. Edgar Bronfman? What's his name? Bronfman?
Yeah, the Bronfman family. Yeah, this is Seagram's was their original thing that they made their money in.
What's that?
They've been in entertainment things. Canadian, beverage.
Beverage.
Yeah.
They're making a run at Paramount. Says the bid gives non-Redstone, non-voting Paramount shareholders an option to sell shares at a premium.
Okay. That the issue is the go shop was with the special committee of the Paramount board, but Paramount's A shares are controlled by National Amusements, and the complexity for these deals are always buying National Amusements, but also getting the approval of the Paramount board for it, right? So that was the issue. We did know that there was a go shop period for that, and they extended it, right, when this offer came in?
Yeah, they extended it. And now I think Ellison's Skydance company, he's arguing that they violated something with that go shop, that it ended or they were supposed to let them know and they didn't. And now they're pissed off about it too, obviously.
I believe there's a penalty if they end up going with a different deal that's meaningful. It could be hundreds of millions. Yeah.
So it says Bronfman has submitted a revised bid of $6 billion for National Amusements and a minority stake in Paramount. According to people familiar with the matter, he formally entered the fray on Monday night with a $4.3 billion offer. The new bid includes $1.7 billion for a tender offer that would give non-Redstone, non-voting Paramount shareholders an option to cash out at a premium of $16 a share. The people said in his initial bid, Bronfman didn't offer Paramount Class B shareholders that option to cash out. So there was a new sweetener that went on it. Ellison's roughly $8 billion offer involves buying National Amusements and merging Skydance into Paramount. The deal would put $1.5 billion on Paramount's balance sheet that could be used to pay down debt. Additionally, it would provide more than $4 billion to buy out about 50% of non-voting Paramount shares at $15 each, or allow them to roll into the new company.
Mm-hmm. Yeah, the complexity here has to do with the fact that you have the super voting shares, and then also maybe National Amusements really needs the money, So that's the difficulty of being in a completely controlled company where you have no votes. I mean, in this case, the B shares don't vote at all. It's a very unusual situation, actually. Normally, you get like one vote and the other get 10 or something, but here it doesn't have any. I mean, does it... I think it says somewhere how much the economic stake of the National Amusements is in it versus the voting. The economic stake is pretty small at this point. So although they have all the votes and they control it, it's a small company controlling a big company, and then there's also debt and all that too. So it's a big asset to battle over, big trophy asset. But this is something that's been done before in media things where they have the super voting and everything.
With Ellison's offer of merging Skydance into Paramount, do you think Paramount is still a good asset at this point?
Well, Skydance is related to the movie studio, so I think that maybe their plan might have been to merge that and improve it and sell off the other things. But I don't know that that was the plan, but that would make the most sense because that's the part that the younger Ellison knows about, that business, and Skydance is a big partner for them.
Well, we'll continue to bring this up on the pod, but do you think this is the end of it? Do you think they'll just take Skydance offer, or do you think there's more to come here?
I don't know if you'll get the value for the for what the assets are really worth. That's always been the problem here, of whether they could organize in such a way to orderly sell off the assets and get shareholders back their money, shareholders of the non-voting shares. And I've always doubted that here. So I think they have kind of non-economic interests in it. And this is a way that probably doesn't go for the most that it could go for. So it's good for whoever is able to finally buy it, possibly, depending on how it's structured. But it's not so good for other shareholders potentially. Although it could be fine because it could continue on, depending on how the deals are structured, it can continue on, and then you could get asset sales later or something that get you your money back. But it would have been better if this had started years ago.
So another piece of news that came up that caught my eye, because it was interesting, because we've talked about Advanced Auto Parts. We probably at the end of last year, I think we brought it up on the podcast, and the stock was down a good amount. If we look at a chart right now, I mean, let's see. So it's down about 20% year to date, but it's off of a high of $239 per share, and it's currently trading around $50, right? So it's come down a ton. And it came out yesterday that Carlyle is buying WorldPac for $1.5 billion. The deal is expected to close before the end of the year. And it says in the 12 months that ended at the close of the second quarter, WorldPac generated about $2.1 billion in revenue and about $100 million in EBITDA, right? So what's that about? Pretty healthy multiple on that business. But, the fascinating thing about Advanced Auto Parts, which I was thinking about, is they're basically in the same business as AutoZone, right? And the difference in the performance of the companies over the past, 10 odd years or something like that. So wanted to see if you could give like a snap judgment on Advanced Auto Parts. So market cap's $3.6 billion, enterprise value is $5 billion. Like I said, they're going to have $1.2 billion after taxes and fees from selling that company. That business did about $100 million in EBITDA. But what happened here at Advanced Auto Parts? It's always so interesting to me when you have same industry, sort of the same business, two different philosophies on capital allocation, right? AutoZone has long been known as a cannibal since like 2008. And the performance of these two securities and businesses could not be more different,
Well,
and I'll pull it up.
Yeah, I think Advanced Auto Parts was doing well until the stock collapsed as a stock. It wasn't doing that well as a business. If you look, the things we look at, right, it's gross profit higher each year, it's operating income higher each year, all those things. It hasn't been for like 10 years. I mean, it's been going flat to down for a while. So as a business, it hasn't necessarily been getting better. And return on invested capital, as you can see, there is lower almost every year for a decade or more. Yeah. When did it peak? Let's see.
2011.
Okay. And then which makes sense, right in the middle of the recession, basically, or coming out, but the beginning of the very slow growth out of it. But it basically was flat to down since before then of 2007 or 6 or whatever, let's say, to, a few years after that peak that lasted 3 or 4 years. And then it's been flat to down on those measures the whole way. But it traded at pretty impressive multiples. I mean, I guess you could see that probably on, some of the key ratios and things of the.
So I'll just read the price to earnings. So let's see when it peaked, and we have it going back to 2014. But yeah, it always trade north of 20, right? So I'll read from 2014 on for the PE, and I'll round up or down: 24 times, 23 times, 27 times, 15 times, 27, 23, 21. So yeah, it always traded at a pretty high multiple of earnings,
which
definitely
is a
more than
very
the
high
market.
multiple for a company that during much of that time wasn't growing. If we look at sales, gross profit, operating income, it wasn't having a lot of growth of the business over time. So that's kind of a high multiple for that to be happening.
Yeah, it was like mid-single digit growth some years, or really
well,
low
if you
single
look at
digit.
it's even easier to see on the overview, because if you go a few years at a time, you can see that it's not really growing that much, especially in the numbers that really matter, which, like I said, are gross profit more so than revenue, especially if you're retail, and then operating profit. The gross profit is, I mean, let's see, if we take 5 years at a time or something, how much does it grow? 2014 versus 2019?
2014, we were at about 4.5 billion. 2019, 4.3 billion.
And then 5 years after that, what was it at?
Back to basically 4.5 billion. Yeah.
So the same that had been 10 years before and hadn't really grown. So, you know, I mean, and there's inflation during that time period, right? I mean, actual car prices, used car prices for the past 50 years have inflated at maybe 4%. I mean, there's adjustments. The Fed adjusts things because they say there's, you know, hedonic things. So like the cars are better. But if we just said, what's the cost to actually buy for cash, a used car for a consumer, it's probably gone up at 4% a year for a long period of time. I would guess it's ahead of actual inflation. So you would think it costs more to repair things over time. So you'd think in real terms that your real gross profit is not going up and that your business in real terms is shrinking a little bit, which is fine. I mean, that's fine, but that's unusual to have a 20, 25p or whatever on that. I guess it's very resilient and people like that it will do as well or better in a recession than it will in a boom. That's true.
Mm-hmm. The quality of earnings. So look at the operating profit. So 2014 operating profit, 852 million, 2019, 677 million. And now, I mean, 2023 was a horrible year, 114 million, but it's just gone downhill from there.
Now they have tended to convert. I mean, I haven't calculated the cumulative numbers. Those are median numbers on QuickFS, but they have tended to convert free cash flow at a pretty good rate versus pre-tax income. Like that's not terrible for a business that has a lot of, you know, working capital. It's actually pretty good. So for an actual real physical business, it does convert into free cash flow pretty well. But we're still talking about, I mean, it often is traded at multiples equal to or higher than over-the-counter markets. And it's grown, you know, a lot less. And its returns on capital are less, right? So I think the stock got ahead of itself when it gets to those sorts of multiples. Why do you have those multiples as opposed to like average multiples for a business?
Mm-hmm. Mm-hmm. Why do you think the business has deteriorated? Is that like competition? Is it, what would you say?
It's a good question. I don't know the answer to that. I mean, I also don't know how much it's deteriorated, really. Like, I don't know how inconsistent the results are. I think the results are more consistent than inconsistent, actually. If we look, it's almost 20 years of mostly pretty consistent results. There was that blip up that we talked about with the coming out of the recession, and then there's bad results very, very recently. But actually, that's a pretty consistent, like, 20-year almost record there. 15, 20 years. There's a long record there. Let's see, do you see with the lip where it starts to come up or where it tops out there? Yeah, a couple years after that, if you go up like there, what year are we there? Let's say one year before that.
2005, 2004.
Okay, so from 2004 to 20, yeah, about 20 years. Most of that is actually really consistent for business, much more consistent than any other business. And then it's not economically sensitive or it's counter-cyclical. So maybe the extreme consistency of the business, even though it wasn't growing or getting better, is an attraction for people. Yeah.
Mm-hmm. Mm-hmm. Compare it to AutoZone that has consistently grown both revenue, gross profit, operating profit. I mean, this looks like a dream if you own this company.
Well, the asset growth of the two businesses is pretty similar. Actually, asset growth and revenue growth is probably not radically different.
No,
certainly
it's not.
Asset, I think,
it's
is
not.
Similar. Yeah.
Look at that. So for people listening, 10-year CAGR in revenue at Advanced Auto Parts, 6%. 10-year CAGR in revenue at AutoZone, 7% if you round up. 10-year CAGR in assets at Advanced Auto Parts, 8%. 10-year CAGR in assets at AutoZone, if you round up, 9%. So it doesn't look that much different. Yeah.
No, and that could be also, even the assets could be a start and end thing because it could be heavy right now and they could have been light 10 years ago, possibly. It depends, but that's very possible given where we are in the cycles too. So they could actually have asset growth and revenue growth more in line with each other. But obviously at AutoZone, like you see there, the EPS growth is good and free cash flow, like we talked about. But you could just see that you don't even need to look at the percentage numbers. You can always just run your eyes across the 10-year numbers and the numbers we talked about. Like if we just use gross profit as the top line, basically, and use that, do we have kind of incremental growth more often for this company?
Yeah. Mm-hmm.
So same thing, if we look 5 years ahead or something, let's say 2014 to 2019, what was the change in gross profit?
For AutoZone, we went from 5 billion to 6.3 billion.
And then 5 years later,
6.3 billion to 9 billion.
So, I mean, that is like a big growth difference over time. And really, gross profit is the only thing that you get to use to run all the rest of your business. Anyone, if they're willing to sacrifice gross profit, can show additional sales in a business that's at all retail oriented or inventory oriented in any way. You just cut your price and you can sell more. I think we had some economic data that people were impressed with sales numbers, but we don't adjust them for certain things. So if you cut your prices and sell more, which is very possible in a single month, that's actually a sign of bad things about to happen, but it causes your retail sales to go shooting up. So you need to know both of those numbers. What you really want to know is what are the gross profits at a minimum of retailers, not really what was the total amount of final sales that you had. But we don't have, government data on that. So it's not just, it is capital allocation, but it's not even just financial engineering, I guess, is what I would say. They're just things more basic. If you look, I think that would suggest one should have a higher multiple than the other. But I don't know. Does it give you EV to EBITDA numbers on the two of them each year? It gives you PE, but then you have to kind of adjust for the structure of the.
Sure. Let's see. It does not on
Okay.
here, but we could actually pull that up on QuickFS. Let's see. So I think we go to historical and we do EV to EBITDA. Okay. And then I think we could also do AAP and EV to EBITDA. So there you go, right there. Yes.
Mm-hmm.
So it has the two. So we can compare, we could go back 10 years and you could see they're obviously very different right now. AutoZone's at 14 times EV to EBITDA and AAP is at 5 times. But for most of the history, go back, they kind of traded very close to each other. At least from 2014 to 28. No, they really always traded pretty closely. I think it looks like they mainly started to diverge in 2019. Yeah.
Correct. I think that you basically have the divergence from what I can tell from it. The divergence in the market's realization of the difference between the two companies is since COVID, or a little before COVID in this case, but it's only going back about 5 years, whereas the results difference easily goes back 10 years, and it could go back further than that. We don't know from just looking at that data. We know some because we have the return on invested capital getting better even earlier in AutoZone's history. So. But some of that is also people look at the stock price. And if, let's say, your earnings per share are going up 15% a year, if your stock goes up 15% a year in some climates, people get a little nervous about that. Even if your earnings per share went up that much, they think, oh, I should take a profit. I should, So some boring businesses that can grow 15 or 20% a year in earnings per share can get where they don't get wildly overpriced, like a hot growth stock, if you can grow consistently at that kind of number, because there are always people who are going, well, why is it ahead of the market this year and this year and this year? Because its earnings per share growth is higher,
Look at this, Geoff, from the quality of business just going downhill. So Advance Auto Parts, will go back to 2011. The return on invested capital looks like it was in the 25% area. And then AutoZone is the green line, but AAP just consistently went down, where AutoZone stayed the same or got better, basically, over the time period.
Yeah. But you see a lot of write-ups of Value Investors Club or whatever things you can think about that are comping things against other businesses. And so at any static point, it might seem, well, you get a little bit lower multiple. It wasn't much at all. But occasionally you might say, oh, you get a little bit lower multiple, or, oh, they're bringing someone in who's going to turn things around more. There's more stuff that can improve at this company in the next 18 months than this company. And so it creates demand for the other stock there,
Mm-hmm.
Even if it doesn't have as good a long-term result.
We could throw O'Reilly in the mix, and that traded. The business was similar to AutoZone, where it got better, but it looks like it started off at a worse spot and just consistently got better. Seems like AutoZone's always been pretty good. O'Reilly's gotten better over time, and Advance Auto Parts has just gone downhill.
Mm-hmm.
I love it, though. Wherever you see an AutoZone, you always see an O'Reilly right next to it, but it's sort of a mixed bag if you'll see an Advance Auto Parts right by it. But I swear, wherever there's an AutoZone, a couple blocks away or right down the street, 20 yards, you'll see a O'Reilly.
Mm-hmm. I mean, we're looking in retrospect, so it's easy to see this, but this is sometimes the case that highly operational businesses, if things don't change with them, have good results or have ways of getting better all the time, as opposed to ones that don't. And that could be organizational things, or it could be other things, and it sometimes gets overlooked. It would be natural for people to look at these three and say, yes, their business models are a little different or whatever, but that there's not a moat around one and not the other, you know? You see it in insurance things, banking things a lot of times that, you know, yeah, it could be argued that there's not a natural moat, but one is operating better and has a different kind of strategy, maybe a different focus on what it's trying to achieve than another.
AutoZone has obviously been a cannibal. Shares outstanding in 2014, 34 million. And where we sit today, it's at 19 million. You can look at AAP and compare that. 73 million in 2014, 60 million in at the present. And then we could look at O'Reilly as well, just while we're at it. O'Reilly Automotive. Wow, they're like AutoZone. They bought back a huge chunk. 106 million in 2014, 61 million where we sit here today.
It's a shrinking business long term. I mean, it doesn't grow as fast as the economy grows, certainly, and it may even not really be growing much in real terms, like we said, at all. We don't have numbers under the hood on that, but I'm sure that as a frequency percentage of people who are actually buying from you for do-it-yourself and stuff, as opposed to what it was before, as a percentage, you know, penetration of the population is, or car owners, it's lower and lower and lower all the time, probably. We can guess that just by looking at the numbers and saying they're not keeping up in real terms and the companies aren't losing market share to the overall industry. So it's pretty clear that that's must be what's happening.
The beautiful thing is, though, Geoff, is that you could have 6 or 7% top line growth, control your gross profits, control your expenses, generate cash, keep return on invested capital high, buy back a bunch of stock. And if you look right here, the 3-year CAGR total return for AutoZone, 24%, 10-year, 19%, 5-year. I should have said that first. Move it over. 5-year, 24%, 10-year, 19%. CAGR. So the results have been incredible.
Yeah, incredible. And I mean, there's lots of famous stories of companies that probably their original market has not grown during much of the time that they were a successful stock. Coffee consumption hasn't grown during the period, you know, per capita and stuff during the period where Starbucks was successful. Certainly the kind of retail that Walmart was originally in hasn't grown as fast as the economy over their period of time. Now they've gone into all of those companies have gone into slightly different things over time, but not enough that it's not just mostly market share gains and just high profitability on a per location basis. Now, you always run into the problem that eventually the per location numbers are a lot worse, and so that's why you have to buy back your stock and everything because you saturate. Yeah.
Yeah. O'Reilly right here. Total return 3-year 22 or 23%, 5-year 24%, 10-year 22% total return CAGR. It's incredible. Absolutely incredible. So I guess if you're Advanced Auto Parts now, what do? How do you get back up to speed here and turn things around?
Well, we have to look at some of the numbers there. So I think we probably want to start with balance sheet on that. So you can see that on a reported basis, their operating profit dropped off a cliff. 2 years ago, they were making 800 million. Now they're making 100 million. There's never been a number like that in their history going back a really long time. But then if we look at their balance sheet, what do we see in terms of like their current assets recently? And we'd have to look quarterly too, but does it look fairly normal in terms of what they're carrying in inventory and what they're doing in terms of, let's see, on an annual basis, that looks pretty normal, right?
We can go over to quarterly, see if it looks different, but it kind of looks very similar.
Well, on an income basis, how did they lose $700 million of operating income that they had 2 years ago? It went somewhere. So how much did gross profit drop in the last couple of years?
I'll just read from 2020 on. 2020, 4.5. 2021, 4.9. 2022, 4.9. 2023, 4.5.
Yeah, so it wasn't from gross profit, or no more than half of it was from gross profit coming down, that's for sure. So it had to have come in other forms below that. What do we see in terms of the cash flow?
2021, 1.1 billion, then 737 million, then 287 million.
Yeah. So that is a big negative that you see, and it will happen with these companies sometimes, depending on the cycle, is that their cash flow from operations is going to vary more because of working capital things. So can we see what large working capital items changed much? Let's look at the ones that are negative.
A big difference was, let's see, change in working capital. I'm just going to go from 2021 onward. Change in working capital, 128 million, 2022, negative 93 million, 2023, negative 51 million. Change in deferred tax, 59 million, 2021, 2022, 17 million, 2023, negative 48 million. And then stock-based comp is jumping around a bit, but I would say it was the change in working capital and change in deferred tax. Pretty big amount.
Let's see. Yeah, so their inventories are about 200 million more than it was a couple of years ago. Their accounts receivable are similar, and their inventory is much more important number than anything else. Their inventory is like a third of their balance sheet or something probably, and that might include goodwill and things like that. Yeah, so tangible balance sheet is even more than that. Liabilities stay pretty similar. So it was generated by having less net income, which means that they had some amounts of higher SG&A basically. But how much higher could they have had? Yeah, well, total operating expenses went up about 300 million and SG&A went up about 300. Yeah, okay. So those are the same number. So that went up about 300 million. And then we said gross profit was about the other 300 million. So that explains about 600 million, which is about what the drop was from 800 some million to 100 some million probably. And then it was a little bit worse in terms of cash flow from operations because we said there was a little bit of a build, right, in inventory essentially, which is not a big percentage build, but if a change in inventory for them of 10% would be half or 2/3 or something of their operating income. Their cash flow from operations could drop by 50% if they had, say, a 15% increase in inventory or something. A company like this, if they had a 30% increase in inventory, would go, even if they were selling at the same rates and everything as before, this never happened, but they just decided that they needed to grow inventory by 30% or something, that would wipe out all of their cash flow, even if they were exactly as profitable as they had been at their peak. So you could imagine. So divide that by smaller numbers and say, okay, even if a little change of 5 or 10% that you shouldn't have had. So maybe they overestimated what their sales would be and everything. It's possible. Do we have gross margins?
Yeah, you could pull that up right now. Gross margins went from 44% average to 40% in 2023.
Which could, if they had cut their price to achieve that, then that might be what we're seeing in terms of inventory and all of that. Or if they just failed to pass along inflation, which could also have been happening if the things that they had were inflating. But that's kind of the factor, is that their sales weren't sufficient. The demand probably wasn't sufficient to what they expected in the last 2 years. I can't really think of what else the issue would have been.
So how do they turn it around? They're shedding assets, bringing in capital.
Well, I mean, what was their gross? Let's just use gross profit as an example. What was their gross profit years ago? Across that line, let's just say from 2014 to today, what kind of numbers do we have? You can round them off. It doesn't matter.
It was always close. It was, we'll say, 4.4 billion, 4.5 billion.
But what was their gross margin?
Margin was always 45% ish, high 44s to 45. It looks like.
Okay. All right, and then their returns on capital were okay, right? I mean, the return that I'm seeing does include intangibles, but I think we just saw intangibles are 10 or 15% or something of the balance sheet. We'd have to check, but it's not a huge number. So in terms of tangible returns, it's not that much higher. So it's really just a question of what the gross profits are and what the turns are. Their revenue right now, we said, what is it? Is it close to 12 billion? What is it now?
11.2.
Okay, so on a cost of goods sold basis, they're turning not even 3 times. They might be turning 2.5 times, though. So you're turning 2.5 times, and you have, say, like we said, 40 or higher % gross margin. Yeah, I mean, you're talking about a high, really high number there of what you could be doing in terms of return on tangible assets, probably. I mean, they have property, plant, and equipment too, but even when I add that stuff in, it's not a problem. I mean, those numbers look really good compared to say a supermarket or something, which would aim at its best to be making, good returns. But like the supermarket will do better because they probably have lower SG&A as a percentage of what they have. That could be a potential problem for them. I mean, SG&A, we said, is about a third of sales. SG&A, let's see, if we look at the income statement, it's one turn, right? So SG&A is normally about the amount of inventory they're carrying. So what was it recently?
SG&A in 2023, 4.4 billion. Before it was 4.2. So it's gone up, right? So I'll just read onward from 2019. 3.6, 3.7, 4.1, 4.3, 4.4. So pre-COVID, it was about 3.6, and we're at 4.4.
So if you turn your inventory like 2.5 times, let's say, basically the first two turns are to pay for everything, and then the last turn that you get is your profit, right? That's what's actually coming through, because the first turns of the gross profit, the first two are being used basically to cover the SG&A, and that's kind of the break even that you have to hit, and then after that you get that last number that you have. So even if the turns decline by let's say by 10% or something, that would feel like a really big change in the business. So it's probably due to turns slowing, but I mean, when we looked, it wasn't that bad. Let's see. But wait, what did happen to gross profit in the last 2 years? Gross margin. Sorry.
Okay, gross margin went down. Yeah, it was, I'll read across from 2021, 44.8, 44.2, and the 40.1.
So if we look at the balance sheet for those same years, did inventory stay the same? Because if inventory stayed the same and gross margin came down, then what happened is you actually basically you only maintained your inventory went up. Yeah. Okay. So that's the problem. Insufficient demand or excessive supply compared to the demand, right? Because what you were doing, I mean, they weren't literally cutting their prices because presumably prices were going up initially in the early parts of that period at least, but they weren't passing it on fully. And so by not passing it on, they actually weren't able to generate even more sales from that to clear inventory. If your margin goes down and you don't clear any inventory, then that's a sign that you're having insufficient demand versus the amount of inventory you have on hand. So here, it's an interesting question of like, why did that happen?
I was gonna say, is that just people going to AutoZone or O'Reilly more over Advanced Auto Parts? Is it competition?
Well, we could look at AutoZone and see what happened with them. Sure, we'll look at their gross margin in the last 3 years. Now, they don't have exactly the same customers. They have some of the same customers, but some are different. So let's look at their gross margin in the last 3 years.
Okay, 2021, 52.8, 52.1, and then 52.
Okay, and then let's look at their balance sheet.
Inventories went up a good amount from 4.6 billion in 2021, 2022, 5.6, and then 2023, 5.8, rounding up.
Okay. Now, the questions that we have there is like, how does that relate in terms of turns? Because if their sales were also going up, then that's not necessarily a problem. But we could also see that from cash flow. If we go to cash flow, has their cash flow deteriorated while their income's gone up?
Cash flow from operations 2021, 3.5 billion, 2022, 3.2, 2023, 2.9. So it's gone down.
Yeah. So that could be a strategic difference too, is that AutoZone has not reduced pricing, but has accepted a higher absorption of inventory on hand. So that would mean that their returns on capital are going to go down over time, and their cash flow is already going down. And then to clear that, they would need to cut prices or to, order less inventory and to have lower sales in the future too. So there's always a mismatch between GAAP and the actual cash flows that you see in the business. That's more indicative, looking at cash flows and balance sheet, of what's really happening in the business right now. And then that gets reported later, basically. I mean, in terms of what you'll see, because if you have too much inventory and you're not cutting prices on it, you don't have to mark it down in any way now, but you know that your gross profit will be lower later, and your earnings and everything will be lower later as that happens. We could also look at income statement to get an idea of what their SG&A is. What's their SG&A?
So they just have total operating expenses on here.
Yeah.
For some reason, QuickFS doesn't break it down, but total operating expenses, 2021 onward, 4.7, 5.2, 5.6 in 2023.
Okay, and then what's their what does their income statement say in terms of sales?
2021 revenue 14.6 2022, 16.2 2023, 17.4 billion.
Okay. So AutoZone has both higher gross margins and it has lower SG&A as a percent of sales. If we look at the balance sheet, then let's see what their turns look like. So what's their inventory normally?
2021 onward, 4.6 billion, 5.6 billion, 5.7 billion.
Okay, so AutoZone has higher turns, higher gross profit, and lower SG&A as a percent of sales. So it's a better business in all three of those points. That's very operational. So it just means that its business model is superior to Advance by a significant amount. Like, the margins are so big in this industry that one isn't necessarily going to push someone out doing that. But if you had that kind of difference in like supermarkets in the same town, one would push the other one out because they'd be able to take all their business with those differences. In a business like this, that's not going to happen for a few reasons. One, customers are less frequent, don't have a good idea of what prices are. They're just going to show up because it's the most convenient place there. So you'll get some business that way. And then two, all of them, certainly on a gross profit basis at least, are so profitable that they don't drive each other out of business. But one business model can be better than another one. And certainly, at least for the last few years, we haven't looked at all past years, AutoZone has a better business model in all the key respects as compared to Advance. Which doesn't make Advance a bad stock. It just makes it a worse business at the same price.
Mm-hmm. Interesting. Well, that'll be a fun one to follow. Speaking of cannibals, I wanted to highlight this company. I tweeted out this yesterday. I follow companies that announce like large buybacks, and I was reading in the Wall Street Journal and Builder's First Source.
Oh, yeah.
They recently announced that they are going to buy back another $1 billion worth of stock. The crazy thing is, Geoff, is over the past 3 years, as I have highlighted right here, they've bought back 45% of their shares, 45% of their stock over the past 3 years. And majority of that buyback was done at, as somebody pointed out, done at lower prices, I think in the $80 share price. But as you can see right now, I tweeted out, Builder's First Source has repurchased 45% of his shares over the past 3 years. But the returns, the stock's CAGR, total return CAGR, 50% over those 3 years. And I said that I thought it was a cannibal that would make Munger proud. But yeah, look right there. Shares outstanding going from looks like under 250 million to 116 million here today.
Okay. You know what I'm going to say about this one though, right?
What's that?
Okay, so these buybacks are timed exactly with cash flow things. So if you look, they've gotten 80 or 90% of all their cash flow for like the last 15 years and like the last 3 years, which is when they did all these buybacks. They were not cash flow generative until very recently, and then they're hugely cash flow generative, and that's when they're buying back their stock.
Yeah.
Yeah. Okay.
I mean, these are very cyclical businesses, right?
Yeah, I mean, this company, let's go to the cash flow statement. Just cash flow from operations is really, really simple. Pre-COVID, what was it doing?
Pre-COVID, 2019, 504 million.
Mm-hmm. Which now for them is like a couple months of business or something, or a quarter or something, right?
Yeah. Uh-huh.
Mm-hmm.
They also acquired a different business too. So they've been like buying other suppliers and whatnot. So their market power has gotten better.
Yeah, but I don't even know that they were, I mean, I don't even know that they were profitable during much of that period, right? So something is happening where they're generating a lot of cash flow from operations recently. And it probably has to do with pricing because unless they went into totally different businesses, their gross profits also jumped from like 25% to 35% or something incredible. So, which depending if you're in a more commodity type business generally means that there's just scarcity in the business and that's what happens. So it could be fine. It's better for the industry than if they invested it back in the industry in some way. If you have unusually high prices, what you don't want to do is invest in growing inventories and everything. So
that's what I'm saying.
That can be better.
Them. Return that capital to shareholders.
They are returning the capital to shareholders, but they're basically buying it back so that you get more and more inventory and more everything over time, So it's different from a dividend. Now they could buy it back and you could sell it. Mm-hmm. The question is, should a company like this pay out maybe special dividends or something like that, or go into a different business line or whatever at a time when this happens?
Look at that asset growth over the past 10 years. 500 million in 2013 to 10.5 billion.
Yeah, so it was like a serial acquirer, before, right?
Yeah.
Mm-hmm.
Yeah. Thought that was
interesting. And maybe the improvements are from other things happening there that cause that. With scale, you could say that your gross profit went up for reasons because of that. But
yeah, interesting. So this week, Geoff, what I want to start doing going forward is talk about like a stock of the week or an industry of the week, something to keep bringing people back and us profiling different things, right? So not necessarily giving stock ideas, because if we're going to record one podcast a week, 52 ideas a year, good luck. But just things that we
Jim
find
Cramer
interesting.
can do it. I think Cramer can do it. So.
Everyone likes to dunk on Kramer to like give. I
couldn't even name
ideas.
As many stocks as he can somehow say that he has heard of these stocks.
He's awesome, dude. He's a great. I mean, people like to dunk on him, and it is kind of funny. But like, he's a commentator. As a hedge fund manager, he was very successful.
Mm-hmm.
I mean, people forget about that, but he's a commentator, right? Do your own research, do your own due diligence. I don't think we've ever purchased a stock based on a recommendation on TV or anything like that. And we never will. But so I wanted to talk about family entertainment companies. Okay. So it's
we
sort
should
of
probably explain what that is. Yeah.
Yeah. It's in our wheelhouse of like circle of competency, things that we like to focus on. You like the business. I mean, you look at like gross margins, high gross margin business, theme parks, stuff like that. Dave & Buster's. Then we could talk about, I want to talk about maybe Bowl, BOWL, and then Top Golf as well, and get your opinion on like just this industry. How it came up for me was I was reading a Value Investors Club write-up on Dave & Buster's, which I thought actually was interesting, and I like the business. Dave & Buster's recently merged with Main Event, and they have new management in place, and their goal is to do different things, change their marketing up a bit, and try to like improve EBITDA. I don't know if I've ever gotten your opinion on the podcast about what you think about like Main Event.
The merger was amazing. Yeah.
Yeah. At what price
this is the kind of thing that's amazing that gets allowed. Talk about anti-competitive things. This is a horizontal merger where they're all in the same places. I was thinking the same thing.
The same thing.
It's great. I mean, even if they just took over the main events and closed them all down, it would be something. Yeah.
I think the last time we talked about Dave & Buster's was 2020 when the stock was like single digits. Yeah. Because
they needed to raise capital and everything because of COVID, right?
Yeah.
Yeah. And then, of course, when it opened back up and people had nothing, they weren't spending as much time working and doing other things. And there weren't movies for years. And there was lots of, they actually then sort of benefited much faster than people might have thought. Whereas like cruise lines or something, it took much longer for them to get back. So it was one of these interesting stories that way. But temporarily, it was like, we could go out of business immediately. When they were shut down for a month or something, right? If landlord said you got to keep paying your leases, because it's all lease stuff with these companies.
So I'll give a background on what he says the business is. We could go from there. He says Dave & Buster's operates in the family entertainment center space. It's large, 15,000, 55,000 square foot locations feature arcade-style gaming, food and beverage offerings, including alcohol, and lots of TVs for watching sports. Lots of TVs. I think they actually put that in their investor presentation. They highlight that. The arcades feature both traditional games as well as virtual reality type offerings. The food is typical bar food, burgers, fries, pizza, wings, fried appetizers, salads, etc. There's a full bar with a large variety of specialty cocktails. So if you're not familiar with it,
priced compared to competing.
Yeah. And these things are usually attached to malls, right? Like good
Dave & Buster's
large
is like
malls.
Always attached to a mall, basically. Yeah, that's the way I think of it. If you see a Cheesecake Factory or something, you should see a Dave & Buster's right there.
Always
They've come in more. They want that kind of thing, more malls than ever before. I mean, especially since COVID and all that, but even the last 10 years, more non-shopping things, right? So they've been attracted to things that, especially things that also have doors to the outside and inside the mall, both. Most people going to Dave & Buster's are probably not coming from the mall side of it, even if there is an entrance from there. But so yeah, they like to add movie theaters, restaurants for, sit down dining stuff and entertainment, things like this all the time to malls now. Try to fix them up.
Yeah, when I was reading this, I was thinking about, I was like, I like Dave & Buster's as a child, and I also like Dave & Buster's as an adult. Whenever you find a business that's like that, you should probably pay attention to it. That's like a good model, I think. If you liked it as a child or you enjoy it as an adult, pay attention to that,
Yeah. I mean, because it's kind of, Dave & Buster's is the poster child for family entertainment, but it's also kind of a lie. That isn't their business. It's not family entertainment. Their business is that we're both catering to kids and to, adults, single adults and people like that. Not so much that it actually is family, but that it's, you want to call it, all ages or whatever, and at different parts of the day. Yeah.
Mm-hmm. It's basically like you're in a casino. There's like no windows or
that's
anything like
that's
that.
The business
You
model.
hear, all the games playing and whatnot.
Sure.
Yeah.
So, I mean, that's the actual business model of a family entertainment center, is to make it like a casino, like a Vegas casino, where you don't necessarily make a lot of money on some of the things that you have. In fact, you don't make any money on some of them, but it's there to drive traffic and to keep people as a captive audience to spend money on high gross margin things. The highest of which are the games themselves. But then also on that, you have things like alcoholic drinks, you have, and then down the list, you have the food, and down, as we said, I mean, you're not trying to make a ton of money on your entrees and things, but you are maybe keeping people there longer doing that. And then anything that you have to have staff for, and they don't have much at Dave & Buster's that would require that. But that stuff probably doesn't make any money, but it's there to lure you in and keep you busy and everything, to play the games and all of that.
And because they are connected to malls almost every single time, that probably added to the selling pressure in 2020, like with malls closing down and sort of the death of the malls and the pandemic and all that sort of stuff too. I remember we were talking
I guess,
about
but
that.
it's somewhat a benefit to them because they're basically buying from landlords. You know what I mean? You're leasing. So the weaker the bargaining position of the landlord, the stronger your position, especially if you're bringing traffic to the mall. But
I just remember that was a narrative in 20, like
Mm-hmm.
when the stock basically crashed.
I don't think that as many people enter from a mall entrance that are also shoppers as people might think, but I don't have good data on that.
So you think they're going to Dave & Buster's because they want to go to
Correct.
Dave & Buster's?
And I think
that's
the
whole
landlord
pitch.
knows that, and that's why they want them. Yeah.
That's the same
I
thing.
mean, why
that
do you
gets
think
brought
there's
up with
Barnes
cheesecake.
and Nobles in some malls and stuff? Because it doesn't even have to be that successful a store. I mean, the landlord wants them. Like, they want those kinds of things on the outside that are bringing people in there. I don't know how much it helps them, but it helps them somewhat. I mean, what's their... I mean, these are huge. We're talking about, what do we say, 15,000 or something, whereas that's 10 times the size of maybe some small store that you might put in. But, would they rather have a Dave & Buster's or 10 Buckle type stores or something? Mm-hmm. Yeah. I mean, they have enough of those kind of stores. They would rather, these are the kinds of things they want to bring there. Yeah, I think so.
Yeah, agreed. That's the same thing with Cheesecake Factory. That always gets brought up, right? Like, are people going to the mall to go to Cheesecake, or are they going to Cheesecake because they're walking in the mall and shopping at Buckle and now they're hungry, right?
Yeah, it used to be helpful before when there was many more people at some impressive malls and certain times of the year. It did help. Yeah, people went to a mall and also went to the movies, went to a mall and also went to the restaurants. And for teens, for some things, that still happens, but not to Cheesecake Factory. Teens can't afford that kind of thing.
Mm-hmm. In 2022, Dave & Buster's acquired privately held competitor Main Event, which operates similar facilities. Although Main Event locations also feature bowling, there are 165 Dave & Buster's and 59 Main Events, with plans to open more. So you've been to both.
Yes.
Which do you like more? Personally, I think I like Main Event more.
Okay. Yeah.
How about you?
Probably Dave & Buster's.
Okay. We're just different. That's okay. Competition in the family entertainment center space is fragmented with two prominent competitors that are publicly traded: Bolero, BOWL, which operates bowling alleys that also have arcades, laser tag, and food and beverage offerings, and Top Golf, MODG, which operates upscale driving ranges with food and beverage offerings. Formerly public, Chuck E. Cheese operates arcades with F&B offerings that are targeted at families with young children. There are also a variety of regional operators that compete with Dave & Buster's, but there are no competitors other than the three just mentioned that approach having national scale.
And I don't know how much I would call those competitors. They're comps for parts of the business, but if we're calling those competitors, then everything that you otherwise could spend is also a competitor. Yeah. Depending on who we're talking about, if we're talking about a group of single people, if we're talking about a couple, if we're talking about young kids, whatever, there's tons of other competition that are just in different categories. The same people are not going to watch those big screen TVs that are going to Chuck E. Cheese. I don't even think they're allowed in Chuck E. Cheese, right? You can't just have adults go to Chuck E. Cheese without children, right? Isn't that their policy?
Oh, is that right?
I think that's been their policy for a long time. I think so, but I don't know. So Chuck E. Cheese is competing with one part of their segment, which is part of their day part and stuff. But it's kind of like saying we have faced competition during our daytime part with this kind of company. Yeah, but there's not. I mean, most towns that have a well, yeah, I would say most towns that have, I'd have to check, but most towns that have a Dave and Buster's would also have a Chuck E. Cheese. There's many times more Chuck E. Cheese's originally. I mean, the footprint's been reduced, I think, but Chuck E. Cheese is a much smaller format. What's it, 1/5 the size?
Yeah.
Maybe even, yeah.
It'd probably even smaller than that, honestly.
Yeah.
Okay, so he talks about the business. The company does 65% of its revenues in entertainment/games, which carry the very high gross margin of 91%. The other 35% of the business is done in food and beverage, which has a high gross margin for a restaurant operation of 74%, presumably because of the higher mix of beverage revenue, both alcoholic and non-alcoholic. And I should say,
it's really
too,
a bar. It's not a restaurant. I mean, it's calls itself a restaurant, but even how the seating works and everything, there is seating that you can have, but it's the kind of seating that a sports bar or something would have. It's just like a bar with an expanded restaurant business, just like many successful bars would have like some food things like that too. But the main things they focus on are the kinds of things that are in a bar.
Mm-hmm. The reason I wanted to bring up Dave & Buster's too, I mean, it looks like the stock peaked recently at $66 per share, and we're at $32 per share. So it has sold off a huge amount. And honestly, if there's actual talks of a recession and whatnot, this is the type of stock, not necessarily the business, but the stock that I could see just from flows and momentum and stuff like that to get sold off. So that's why I was like, okay, could be an interesting, because it looks cheap already. And if we actually do go into a recession,
5 times EBITDA.
Yeah, that's my point. Yeah, I was like, it's pretty cheap.
That's remarkable. And that's not that shocking, because it's only at 10 times like pre-COVID EBITDA or something, because it's not like EBITDA went shooting up and they own a lot more things now.
Mm-hmm.
Because that hasn't been restated to reflect that, I don't believe. For QuickFS doesn't have restated financials from previous periods. So,
let's see. So it says, after the closing of the Main Event deal, most of the C-suite of Dave & Buster's turned over, with Main Event CEO Chris Morris assuming the role of Dave & Buster's CEO. And then it says, this guy writes, or gal, this change of management is an important piece of the Dave & Buster's story because the company has historically been undermanaged. Under prior leadership, Dave & Buster's simply had not been following many of the best practices of retail and restaurant management. As an example, they only recently began building a customer list that they can directly market to. Another example, also regarding marketing best practices, until recently, almost all their advertising was being done on linear TV, and they spent almost nothing on digital. So he's making the case for a change in the marketing a little bit, right? It says, at its June 2023 Investor Day, the new management team outlined a series of 6 operational initiatives that they believe have the potential to grow EBITDA by $430 million to $600+ million. Given the company did $556 million in EBITDA last year, executing against only a fraction of the opportunity defined last year would be a game changer to EBITDA. So that's the part that kind of caught my interest.
That scares me, the Main Event people coming in doing all this. Yeah, I don't know that I agree with any of that. And they might run it right into a ditch. Yeah.
How could they do that?
That's what I would be scared. Well, because why should Dave & Buster's be run more like businesses that are inferior? You know, like all the examples that they're giving to copy the marketing that they're doing and the other things that they're doing at the other ones. None of those businesses make as good returns and stuff on the underlying store economics. I don't think so. And Dave & Buster's record was actually okay, considering, you know, going into COVID and everything before then. So, yeah. I also, just as someone who went to Dave & Buster's and stuff, I think that their marketing was perfectly good and actually probably pretty cost effective and everything of how they were doing it. But
yeah, he said, so this is the 6 levers for organic revenue growth from marketing optimization, strategic gaming pricing, improved F&B, remodels, special events, technology enablement.
Yeah. I mean, look, they have play cards and stuff in it, and then you carry those over and everything, so they have data and all that. That's the part that's important, to know who your whales are and stuff that way, and what they're playing and how much, and you know, what that drives in terms of the gross profit and everything. There's a lot of operational complexity added by increasing the food, and the food part is certainly, but even food and beverage just in general. Cleanliness concerns, all sorts of things once you go down that road. And so I don't know about that. Having a very good idea of what they're doing when they're on premises, I think, is some of the most important, and targeting them for reactivation that way is somewhat important. But basically having the right mix of people playing the right mix of things in terms of how high it drives your gross profit is something I would focus on more. And I would, like I said, it's a casino, really. It's not a restaurant. So I think, to be completely honest, people from a casino / resort hotel type thing would be more knowledgeable about that kind of thing than people who are from the other side of things. And I think bowling is actually quite different, and it's combined with family entertainment things, but I think it's the least similar part of it. It brings people in and uses it during other periods of time, but it's interesting how completely 100% dedicated bowling things are different from things that combine it with other stuff. I put it in a different category, definitely.
Mm-hmm.
But
what do you like about this industry?
well, look, I like any industry, certainly where you have a audience that's kind of captive on premises, and then you can be maximize what you're doing for their enjoyment and your profits throughout the premises. You know, I mean, I like a supermarket type thing that way. I like a family entertainment that way, or a theme park, or you could say that, or a casino, or whatever things. You have a lot of information about people and what they're doing. You can see it right there, and you can design things to drive the profits that way. You also have a wider selection of things that can keep them coming back and enjoying it through synergies that you have, like a cruise ship, right? A bigger and bigger cruise ship. In general, they've made the cabin smaller and smaller. That's not what they're competing on. They're competing on the idea that there'll be more experiences, more different things, more whatever that you can do for everybody, and you have more choice that way than you would on a small one. And a very large premises allows for that. Now, one thing that is interesting is that in general in this industry, an odd aspect of it is that the larger and larger the place is, the lower the returns are on like a per square foot basis tends to be.
Mm-hmm.
Yeah. Which is unusual. In most industries, that's not what would happen. And so you wouldn't build ones as big as what they have. But that's not necessarily bad. It you know, your operating expenses and stuff can be lower, and there can be other benefits to it too, like we talked about with rent and all of that. But it isn't necessarily the case that, like, if you had a highly trafficked arcade only thing that was 3,000 square feet, like we were at some place that was a boardwalk, right, in New Jersey. Yeah, that's a more profitable business model. It depends on what the rent is and everything, but no, you can't compete with all these other things that you offer on a bigger area as you can with a really packed in arcade in a high traffic area. That's going to make a lot more money, obviously, on the gross profit things that we've talked about. Yeah. So stripping all of that out, offering no food, offering no any of that stuff, and just focusing on that, yeah, it's more profitable. But you can't do that in town after town around the country. You could only do that in vacation type, already like destination locations, right? That you could put something like that in and make money. These, you have to make your place a destination and then get them to play the arcade games.
Mm-hmm. So what do you think about Dave & Buster's on that 5 times EBITDA? Is there some potential here? Is there enough of a margin of safety for you to be interested? I mean, that's pretty cheap for a company like that.
Yeah, I guess then I would have to know more about the management that's taken over and what their plans are.
Okay, so it's a great example. So
Yeah.
plans, management, take us through that thought process. People are always asking, what are the right questions to ask? What would you be focused on? So
the marketing thing is one problem. So I think customer acquisition cost is going to be very, very high if your idea is that you're going to go out and get new customers who aren't already coming to your place, right? So I think that's tough. You know, there's not a huge number of people who regularly play arcade games, for instance, and account for a large amount of your spend. But there are some people who come in and buy $100 card and start spending it there, and that's going to be very valuable to you, as you can imagine, versus other things. I mean, you could certainly draw people in to do the food things, but if we do the math on that and the food things, they'll spend, you know, versus the person who, you're not going to get a lot of people who are coming back all the time, right? So your margins are going to be lower, and also the difference between your worst customer and your best customer in restaurants is not going to be the same. I mean, some restaurants are, if they have like lunch business for business people and stuff, they can do incredible numbers where someone goes there every day basically. But for this kind of thing, you're not. So you're going to go out all the time trying to get people to come in to watch a football game and eat wings versus trying to find people who want to play arcade games. I don't know. I mean, that's probably the thing, that marketing is easier to find those people. There's this bigger pool and to drive them there. But is that really the best part of the business? I mean, we looked at some casino things where in COVID they realized, oh, maybe we should just like have half our people not come to our casino and make more money, because we didn't have good data on the fact that we're making all our profit off of half of the people who come here.
The
and
whales.
Guess what? It's a better experience for everyone else if we understand our players and if we cater to them and get everyone else out of here.
Yeah.
Yeah.
So understanding the marketing, understanding management. You've said before, I don't know if it was on the podcast or maybe in person at an event, that, everyone always wants to talk to CEO about like different things, but if you could talk to like the head of marketing, that's somebody that you'd be so interested in speaking to at these companies.
Yeah. I think the most interesting thing here would be, okay, let's not worry about getting people in the door the first time. Whatever. We're in a place, it'll show up on things that people can do. People have friends, they have whatever, they'll go there one time. Let's not worry about that. Let's worry about once they're in there, what does it look like for people who repeat? What does it look like for people who spend a lot, whatever? And then let's try to see how we could focus our marketing dollars on that to actually drive gross profit to be better over time that way, But it's just a question of what you think it is. If you think that it's mainly like a food and beverage type thing, or if you're saying it's more like a casino or theme park or something, well, those things are run incredibly differently. And of course, it depends within a category that way. Six Flags is run completely differently from Disney. They have completely different economics in terms of how you do it. I mean, in Disney, you're trying to get people to repeat and spend a lot of money and everything. And at Six Flags, you're trying to you're running like a seasonal business, and you're trying to drive a certain amount of attendance basically at lower prices there.
Yeah. What do you think about Bolero or Callaway Golf Company, which owns Top Golf?
My biggest concern for all of these, Dave & Buster's on all the way down, is that it's very easy to expand these businesses and to compete. And so that scares me. It's what scares me with restaurants. I mean, if you have one unit that makes money, then you can just go to a landlord and lease another one and lease another one, lease another one, and you can expand quickly and cut into the margins and everything. And so that's my biggest concern with any of these, is over competition. I think that's always the big problem. They could do other things wrong, but I don't think there's much likelihood other than they or their competitors expand too much. So you just kind of have to do the math on a town and say, does it make sense to put it in here given the population? And then if there's a few in here, is there too much? You can do it for anything. I mean, with movies, we've talked about that. It's pretty easy to calculate. You can say, okay, there should be 40,000 screens or something in the country. Here's the population. What are the differences in the population? But basically, is this place under-screened or over-screened or something? Same kind of thinking here. It does depend on the demography, but you still want to, I literally say at Chuck E. Cheese, I think they look at the zip code, say how many kids between these ages are here, and there should be X number of Chuck E. Cheeses per this many thousand kids in an area within a driving distance. And I think that is a concern sometimes with some of these companies, especially when they're public. So, because you can sell this on, okay, we can grow, and here's our unit economics and whatever, and each unit might be worse than the unit before as you grow too much, and it's just like it'll scale up and it'll get better,
Mm-hmm. Why do you think?
Yeah.
Why do you think it's trading at such a different valuation than these other companies?
I would have to know more about the situation of what's been happening recently. I mean, have they been disappointing on their guidance and everything, and do people have doubts about this management company? I mean, when we talked about Six Flags, I think that is kind of what happened, is that there was some interest in the management when they first came in, and there was like, oh, it's not going as well as we thought. And then, it was, there's going to be an acquisition, so, merger to close that out. So, I mean, the write-up certainly made it sound like that, like there's going to be a pivot into better things. And that's a recent write-up?
This was from June 30th, 2024. Yeah.
Okay, so that's not that bad.
Mm-hmm.
So I mean, what was the price on it at that time? Not that different. Was it like 40 or something instead of today's 40? Price?
Mm-hmm.
Yeah. Okay, but this is a stock that peaked at, I guess, twice today's price. It's back to the same levels that it was at recovery from COVID. Actually, it's not that far from levels that it was at before COVID, right?
Yeah. Mm-hmm.
Is that true?
Mm-hmm.
Because it used to be a very popular stock before COVID, so that's remarkable. But it is also interesting, how did this happen that Main Event took them over? Because like when I look at the headquarters now, it also does not give me the headquarters that I thought from living near. It was Dave & Buster's headquarters. It gives me the headquarters that's, I assume, Main Event's headquarters. There are only a couple towns over in Texas, but I think that It literally is like Main Event took it over.
Mm-hmm. Yeah, now they're all running it. Yeah, it's weird, huh? It's interesting.
Yeah. So you don't know though, like if it's, let's see, we could see on the chart if it drops on days where they've reported earnings or something. No, it's been pretty consistently down since. Like, could it be recession type fears?
That's what I'm wondering. I don't know.
I mean, I'll
feel
try
like,
to. Let's see if I could put something else that should be recession-y next to it. Let's see.
I feel like this is the thing that
So-
people would sell off or be worried about, right or wrong,
All right.
or just it is something that would naturally happen.
Mm. Yeah, what would be okay? Wow. I mean, it is. Look, the other thing is indexes and things like that. What is this? I'm assuming it's listed as just consumer discretionary. Is that what category they put in? Do you know? Like QuickFS and stuff probably says what it thinks it's being categorized as. What's it in? No, hotels, restaurants, and leisure, it says.
Yeah. Oh, consumer discretionary right there to the left sector. Yeah.
Okay. So it could be being affected by that. It has insane share turnover. No one wants to own this business for the long term, even though I think on a unit basis, I've always thought that it has good economics. So I don't know why that is. But same thing with Marcus and Cinemark, right? When we talked about those, it has the same sort of thing. Insane share turnover and violent movements based on assumptions about the economy. Now, I have to say, this is more economically sensitive, potentially. Dave & Buster's way more economically sensitive, potentially, than either Cinemark or Marcus. And Marcus is somewhat more sensitive because of hotels, but even more than Marcus. Because the spend potential is heavily uncapped at a Dave & Buster's. So, which makes it like a casino that way. The thing about a movie theater, one big reason why it's not very economically sensitive is you just can't. You may think a movie theater is expensive because you want to spend a very low amount, but you can't find ways to spend an incredibly high amount. I mean, you could have 8 kids, but there's just a limit. I mean, you're going to have. You only have 2 free hands. What can you can buy $8 in each hand for concessions, and you can buy a $12 ticket or something.
You can only eat so much chocolate, right?
I mean, you have to physically move it yourself. I mean, some have food and beverage that they bring to you, but you are limited. At some place like a casino or Dave & Buster's, you can stay there for many more hours, and it's all done digitally with a card and everything.
Card.
And
you
can open a tab at the bar. Yeah, you can spend a lot more. So that can definitely get cut back on a lot more. The same way that you'll see a difference with like Swatch or something, Swatch, most of their brands are not the Swatch brand. So high-end watches versus, a Movado, or go even further down like a Fossil or something. Like there could be a much more of a drop off in a recession because in some parts of the world, if people are feeling less rich, they're not going to buy really expensive watches. They're also not going to go to places like Dave & Buster's as much. They're instead going to go to other places. They're going to say, kids, you have to go to, a movie instead of Dave & Buster's. You have to go to Chuck E. Cheese instead of Dave & Buster's or whatever. You have to go to Six Flags instead of Disney. Someplace where you can't possibly spend as much money,
Yeah, I mean, if you're going to Dave & Buster's versus a movie theater, I feel like going to Dave & Buster's would probably be more of a better, more fun, more expensive day out than a movie theater, right?
Oh, of course. No doubt. And the frequency is much, much lower. Obviously, if we took all the family entertainment centers and compared it to the frequency of movies and things, is much lower. That's why I'm saying, though, that from a recession perspective, a lot of times people try to replace the experience they have at a lower potential top spend, especially because what people will start to realize, like a lot of people don't know how much they are spending at Dave & Buster's, right? That's part of the thing about it, the same as a casino or other things too, where you can split the bill across different things, and so you don't see it all at one time what it is,
Mm-hmm.
Yeah,
it's a casino for kids, Geoff,
and adults. That's what makes Dave & Buster's a lot more successful, is their ability to fill up so much of the times of the day and everything with different groups of people, different specials, use the space so well. Yeah.
Mm-hmm. Mm-hmm. Cool. So we have a couple emails that were sent in. Thank you to the people that sent them. If you want to email us a question to have it pulled for the podcast, email it to me at andrew@focuscompounding.com. Let's see. And one of these was a follow-up question from a podcast we did 2 podcasts ago where we talked about Marcus. And it says, when evaluating Marcus as a prospective investment, how much, if at all, does the key supplier to its theater business concern you? for its concentration. Rough percentages of box office revenue, greater than 25% from Disney, 18% Universal, 16% Warner, 15% Sony, 10% Paramount, and 15% other.
Yeah, it doesn't concern me at all. So there's a few reasons. One, if you flip it the other way, from the movie theater's perspectives in the United States, it looks very similar. It's AMC, Regal, Cinemark, etc. They're getting 50%. I mean, the top 3 theaters or something could be accounting for 40% of their box office or something. Top 7 could be closer to 60%. I mean, I don't know the exact numbers for each company because depending on what they release, it would be a little bit different. But yeah, so in the United States, they, on the flip side, look very similar. The other things is that both of these groups basically, although they don't negotiate as groups with each other, they have trade groups and things. And so they basically have like model deals, like trial balloons, that are how they work out what relationship they're going to have with each other for the most part. So like when you had something with the window and it was like there was a deal that, let's say, was done by, I forget, but let's say Universal and Cinemark agreed that movies under this amount of box office will no longer be put on our, Peacock or whatever within 60 days or something. That's actually like a test to be for all movie theaters. You know what I mean? Even though it's negotiated by one. So it's similar to like when unions negotiate with car companies or when they negotiate with an airline or something. You can tell that will probably be the template for the other deals there too. So they deal with each other as groups that way. There are not the same restrictions that there were before, so it could change, with the Paramount decision. There were things that were illegal in the United States that aren't illegal anymore, but it wouldn't concern me. And then honestly, like historically, there's stuff that I don't even know is disclosed. Like if you look at, say, a network TV thing, they would have said that years ago when they weren't allowed to do production on their own, they would have had a huge number of a huge percentage of their shows coming from a few production companies. But that's not a serious problem because you just find another production company. You are creating the demand there by doing that. There's a limited number of the screens that they need to be on, and so they have to put it all everywhere. And you're basically going to get it on like a commodity type fashion. There are some slight differences to things. And they do court each other a little bit on stuff. I knew people who worked at Cinemark. I lived in the HQ that they had. They did have a dress code for when Disney was on premises that was not enforced for any other studio. So that gives you an idea of whether they care about the other studios.
Look busy.
And their beverage partner.
Don't be standing around on your cell phone.
Yeah, your most important one is going to be the beverage partner for any of these theaters. So like Cinemark, I believe, is a Coke partner and was at the time. So of course, all over their HQ and stuff, everyone gets free Coke and every flavor you want and every whatever, because Coke is courting Cinemark like they court airlines or McDonald's or whatever. So of course, these are really, really big items. And you can do the math on that and say, oh, wow, every weekend, this one customer is, millions and millions of dollars of syrup is being sold through Cinemark, AMC, whatever. And if Pepsi takes this account from us, oh boy. So it works both ways. Yeah.
Mm-hmm. Look at that price divergence. Did a podcast on it, but crazy. Cinemark just keeps going up, Geoff. It's up 97% year to date, and Marcus is still down 3% year to date. Crazy.
Now, I do have to say there have been deals struck, and Disney struck them, I guess, just pre-COVID, just before COVID, that were slightly different from normal deals with box office split. So,
like what?
Different percentages. There's no set percentage. In the United States, it's easy to estimate that it's a 50-50, but that's not really how the deals are structured. The deals could be structured differently because they require usually minimum commitments. So like if you hear limited engagements or something like that, that means that they weren't able to get theaters to agree to the 2 week minimum. So normally you can't book any screens unless you agree to take the movie for 2 weeks, right? Because that you're not showing sufficient support for it that way. So when you have something that says that there's limited engagements, that means that they could take it out in 1 week. The other way to do it is like to say that it's in certain cities first as a test, and then you can show them that it worked in LA and New York, so we want to expand it. So that would be like committing to only certain theaters having it as opposed to committing to only certain screens having it. And And then for some movies, you'll make more as the movie goes on, or less, depending on a sliding scale, which would be decided to encourage them maybe to play for longer. Because what will happen is, from the theater's perspective, I mean, there's a variety of different interests involved, but right, from a theater's perspective, historically, you would want to play the movies that have the highest per theater average. Also because, remember, half of your money is coming from concessions as opposed to just revenue at some theaters. So it is much more in your interest to not play things that would play well because they require more showtimes, more screens, whatever, as opposed to playing things that are fairly full. It's in the theater's interest to be fairly full. And so not to play things indefinitely. It's in the studio's interest to play things as long as possible before streaming, because we're still making money on it. So why not make money on it? This gets into an issue with support of the theaters and the studios for things that are released but might not make enough money. So, okay, so like, for instance, there's a movie out now, Coraline. It's a re-release. It was out last week. It'll be out this week. In a limited fashion, if it's released the same way as, say, Phantom Menace was, where it made like $8 million or something, I think Coraline made similar amounts in a single weekend, that's fine. But there's actually other movies. We'll see what The Crow does. We'll see, I don't think it'll end up making much more money than Coraline or a re-release of some other film would be. And it might require them to play it for a few weeks. So I think like Apple did wait, I might be mixing up who it is, but I think it was Apple. It could be Amazon MGM. I think it was Apple. Did Fly Me to the Moon earlier this year. And they were going to do Wolves, and I think they're not going to do Wolves now in theaters. So something like that is complicated because it may be that if it was a limited amount of time, it would be fine in a per theater average. But if they want to say, oh, let's run it for a month and it'll make some money over that full time, from the studio's interest, that helps. It makes money. But then like on a per screen average, it's not very good. So that's more the concern that they might have. If you agree to show it for a really short period of time, like the concert event for Taylor Swift or something is very attractive to movies, and they'll take a lower cut. So if you had that, and especially if you agree to put in a time when they're not going to play other things, you could probably negotiate a deal where they just take it because they want the concessions and everything.
I was going to say,
if you're saying it'll only play for a few weekends, it'll only play at certain times, I only have to show it at 7 p.m. and you're guaranteeing me an audience, sure. If it's a dead month, let's put it there and I'll make money and everything. But getting me to commit to it, what they don't want is like a major studio movie that flops. So, I mean, Borderlands was Lionsgate, but that has to play for a few weeks no matter what, and then it's going to be playing to pretty empty screens. I mean, I saw it at the smallest screen they could put it on, so they knew what was coming, but that's still a problem,
Mm-hmm. Do you think those concert films are more likely to generate more food and beverage revenue, alcohol revenue, and stuff like that for movie theaters too, than the standard movie?
It might. It's a long movie. And they couldn't play anything after it probably anyway. So, I mean, it's good. They would like doing it. But that one was also complicated because I believe basically Taylor Swift or whoever her company is or whatever probably was taking a huge cut. And then it was being distributed by a movie theater chain that was taking the other part of the cut. And so there was probably less left over for others. But then there's also pricing differential and things like that. So, I mean, they're kind of like airlines. From the simplest thing is movie theaters like butts in the seats. And that's the most important thing for them. They can figure out how to make money if they have that. They don't like a lot of empty seats that don't have people in them. And so that's more what the relationship is about with a studio or something like that. But it is true that there was a time where there was like, oh, we should get a little more on a Marvel movie. You should keep a little less of it than we do or something. But even then, that might be okay if there's other factors, because the theater's only the theater also is getting concessions either way. So from the studio's perspective, it's 100% that you're negotiating over. From their perspective, it's like 50% of the pie that we're talking about, because the other 50% you're not affecting our concessions, And then the other thing is like some of these have upsell things that are fine for theaters too that they like, but that limits the capacity sometimes. So they like movies that can play on IMAX and these premium large format things and everything, but that sometimes hurts. Like Mission Impossible would have had higher attendance if so many people didn't want to see it on a big enough screen because it probably sold out in some towns for desirable seats at desirable times the first couple of weeks, you know? So it is a trade-off that way. But basically they want a hit movie at a time where they don't have other hit movies, and you can supply it to them, and that's really what they want. I mean, the industry's set up so that both the theaters and the studios, and even competing with each other, all want everything in it. They would like, as much as legally allowed, to work together to make each release as highly attended as possible. They intentionally don't release things against each other that they know that the same person wants to see, you know? So it is not the kind of relationship of, am I worried about Costco? Would I be worried about a company that's selling too many batteries through Costco? Yes, I'm worried about that. Am I worried if Disney's selling too much through AMC or Cinemark or vice versa? No, not worried at all. In large part because there's rarely much negotiation about price. The price of the ticket is what the ticket is, which is the same as basically all other tickets, and the cuts are very similar. And so the terms are pretty similar. So it's just, do you want it or not, you know?
What are the new economics of those new deals with Disney that you spoke about?
Well, so in that case, I mean, I think this is all public stuff and whatever, but I mean, they would have gotten a slightly higher percentage of opening weekend stuff on certain highly desirable titles, is what I would say. And then like scale down over time on that, right? And then even on that stuff, like that's dangerous because it depends, but you can structure deals all sorts of different ways to make everyone happy, which is what you want to do. They will do that no matter what, because they're not going to screw you on a deal. Then they're going to have to come and negotiate you with the next one. I mean, like as an example, I can tell you that I've seen movies where the studio doesn't particularly want to make the movie. They made it, but they don't really want to make it. The theater definitely doesn't want to take it. But it's playing in the theater because the studio wants the actor or director or whatever to do another picture for them that they really want. And so this is to keep them happy. But the relationship is good enough with the theater that they can say, look, we'll make it up to you. We'll figure something out. But this is a Matt Damon vanity project. You've got to play it for 2 weeks, and you can be in your smallest screen and your most indie-centric things. But we want that because he is going to be Jason Bourne for us next year. Okay. And this is how we do that. And so that's like the relationship, which is different than other things. It's a cozier relationship, I would say, in general, than some of the other things we're talking about. So that something like retail supply, when we're talking about supermarkets and Costco's and online things and all of that, when I talked about Nike and the things they sell into, that's where I worry about it more, and about companies pushing that too far and not being smart about that. Because they tend to try to think, oh, I'm the brand, I have all of this power, and the distributor really doesn't count for any of that, or vice versa sometimes, and not realize the value that the other one is adding, and that the entire profit pool of the whole ecosystem needs to be high enough. I think that in general, theaters and studios are smarter about that than, say, supermarkets and brands that they sell or something. And definitely, there's always things where probably Target or Walmart or Costco or whatever push things too far that way, or vice versa when others have the ability to push them on it, instead of working together to do something more intelligent for the long term. Yeah.
Next question that somebody emailed in. Do you think it's a coincidence that most of Buffett's investments were in companies whose customers were individual consumers, not other businesses? Deposit-heavy banks, insurance, newspapers, consumer brands like See's and Coca-Cola. Or is it not a coincidence, i.e. consumer-focused businesses generally have more pricing power? Do you favor companies whose customers are people, not other companies?
So not necessarily. They're completely different. What I like is companies that don't have bargaining power. Your customers don't have bargaining power. So there's a few ways that can happen. For the general public, that is to serve the highest number of people with the least amount of bargaining power. So it is to sell to the general public, here's a candy bar and you each buy it or whatever, That's great. For businesses work the opposite way. Businesses, you need a non-price competition thing. And then you can have them forever if it's just too complex. So if you make it where it's too difficult for them to switch away your product because it creates some headache for them, it's not their money ultimately. I mean, small businesses, the owner operator, they're maybe caring about it, but in business, people are very free with wasting money if it avoids a headache for them, which consumers are not. So you need to have a product, So an accounting system, a customer, what do they call it? Customer relationship management, things that keep track of that sort of stuff, database things in the background that no one knows about, but
core processors,
even some point of sale systems. And I mean, like just anything that they're like, oh, this would cause me a little bit of pain for a while. That's great to sell to a business. Yeah. So information systems that you sell to businesses, anything you can integrate into a business, that stuff's really, really great. But in general, yeah, you want to be a very large, you want it to be a huge relationship from their perspective and to have thousands and thousands of them and everything, So, I mean, that's why when I talked about the theme park thing, something Disney, right? So Disney has millions of people who, for them, the big spenders, Disney is their most important entertainment relationship with the customers. It's the thing they know that resonates the most with them. And then to Disney, it's millions and millions of people. So there's no negotiating power on one side and there's all on the other and everything, So yeah, I think that Buffett's very, very good about product economics, about the understanding the customer things that way.
Do you think customer behavior is more predictable as well?
Oh yeah.
Yeah,
I mean,
agree.
He's like Jeff Bezos that way, right? Jeff Bezos is like, why don't we focus on the things that aren't going to change in the long run rather than the things that are going to change all the time about the internet and everything? And that's Buffett's approach. This stuff isn't going to change. How you deposit at a bank and insurance and all that. I mean, some of the things did change, unfortunately, for him with newspapers and all that, but it often changes in that, unfortunately, what you owned no longer is there's a similar thing replacing it, but it's not developed by the same company, unfortunately, right? So they can't make that transition. But yeah, it's consumer-focused businesses are very good to have because you have a very low amount of bargaining power on their side. I mean, that is the really key thing, is the value of the two sides that you have, your costs and what bargaining power there is there. And then on the profit side, on the revenue side, which gives you the profit spread between the two, is, their bargaining power with you. Now, I think he's even said, buy a commodity, sell a brand. The ideal thing is for both sides of that relationship to be heavily in your favor. So you go out and you sell to consumers, millions and millions of them for Coke. But then what are you buying? Sugar, aluminum, whatever, at each, I mean, in Coke's actual example is just syrup and stuff, so they don't even need the things that that I'm talking about with needing the bottling and all that. But throughout the whole system, we're talking about commodity type things, and then you turn it into Coke that way. It's obviously not as good if you're, if you're just buying it and then marking it up and then selling it to someone, where there's a dependence on the other side of it. So you want to be able to bargain with your cost side, be in the stronger bargaining position. And you also want to be able to bargain on your sales side and be in the better position. And those two negotiations will tend to get you better results. Now, the thing is, and this is why Buffett waits until buying them at the right time, that only gives you the potential. You then need a good operator to actually make it work. So there's lots of banks that probably have the kinds of consumer kinds of product economics that would naturally be, in terms of negotiating factors, what Buffett wants. But they're not penny pinchers and they're not smart about everything else. And so if they then are making sure that they don't have the loan losses, they're making sure that they have the lowest possible cost to operating that branch, so you have an Illinois National or, the Rockford Bank, that's something special. But lots of banks would have had some sort of economics like that, given the laws and everything. But then you had a guy running it who was a real penny pincher that way. And so you get the full benefit to the owner. There are other brands that probably are like Sears or Coke, but they don't quite make as much money as they should because they're not careful about that. I mean, Buffalo Evening News, when he took it over, they were buying their newsprint in a way that was a lot more expensive. Than he took it over and immediately changed how they did that. They always had the same bargaining power. They just didn't use it until he came in, So it's the potential, and then it's whether you grasp that potential or not, and that's the operator part of it. So some of the numbers we see with AutoZone and stuff, it could just be that they're also good operators. There could be other companies that have some of the same economics that they have and haven't fully, throughout what they do, taken advantage of all that. So the difference between the business models inherently may not be as great as what we're seeing. It could also be that AutoZone may be a better operator than others. It can't be all of it. Some of it is There's got to be other stuff there that probably it's inherently a better business, but some of it can change if management changes and if the culture changes.
Mm-hmm. Well said. Final question. Again, Andrew at focuscompound.com. Email us. How do you guys think about companies with high free cash flow per share, but negative net income? So we kind of talked a little bit about that earlier, right? Okay. For example, WBD has been free cash flow positive for several quarters in a row and looks cheap on a free cash flow basis, but still has negative to no earnings.
Right. Well, they're not, so WBD, I believe, is Warner Brothers Discovery. Are we talking about the same company, or what is WBD?
Let's see. I believe so. Yes, correct. Yep.
Okay. Yeah. So look, in the business that they're in, earnings mean nothing. So, they can write off whatever they want. And now why do they here's the issue. Why do they have free cash flow and everything? What's really going on here? They got a lot of debt. And so they're not running this business for you, the shareholder, right now. They're running this business to not, be not able to pay off their debts, right? So
19 billion market cap, 52 or 53 billion enterprise value. So yes, a ton of debt.
Mm-hmm. So this company's famous for this because, like, on Max, they pulled things. They're now not available anywhere. This is the problem with digital things, right? So there used to be, there'd be DVDs or whatever in the time of books and all that. But now companies, if they own it, could pull it, and they have pulled it from their service. So they sometimes own the rights to something and have taken off their service, probably, to be able to expense some things now and get some tax benefit from that. And then, but that means you'll never see it. It will never be seen by anyone ever again, And if you have some things where that was never put on hard copies of things, that content's gone. Now it's content that probably isn't very popular. They also killed a couple movies, Warner Brothers, for probably similar reasons, right? So they're very, very focused on this. It's, you can write off a lot of stuff. I don't know how much of their things have been write-offs. Recently, they've been huge. And some of those are write-offs of different division things entirely, because there was a merger, so they could do that with the goodwill. And then also you just have write-offs of things in film inventory where they've been aggressive with and everything. It's a very complicated company, so there's not a breakdown of enough things that we could really judge what they're doing. But in the long run, it's cash flow that matters, not the income stuff at all. So,
John Malone built a very valuable company without paying basically any tax, right? All about cash flow.
Mm-hmm. It's worrying that they have as much debt as they do for the kind of business that it is. And also people are a lot more optimistic on them as a mix of brands and everything than I am. I've talked about that where I was like, Paramount's done terribly, but I think Warner Brothers stock has also not done well during that same time. And everyone was not everyone, but value investor type people were more bullish on Warner than I am as a business. I think they're kind of...
Yeah, it's just gone downhill. 5-year return down 72%.
When was the merger closed? Do you remember that? We can find the date. I can find the exact date. And it was kind of I don't say a minnow swallowing a whale or what. Okay, it complete April 8th, 2022. So let's go back to that. Let's check that date. So we can check like from May or something on of 2022 to clean up the numbers.
April 2022. Yeah, look at this. Yeah, it was way higher. It's down a good amount since then.
Yeah. So it was basically like a way for Discovery to go into Warner. Warner had a lot more value long-term, probably, like more durability, Warner Brothers, than...
Here you go. Looks like it was around
$20 Discovery a share. Yeah. But both sides had cable properties that probably don't have a lot of value in the long run. Streaming cable, that's a big problem, that they are the same sort of thing. And the economics of moving to streaming aren't as good as what they were with cable before. And there's not going to be as many streaming channels in the future probably that are successful as there was with cable, where we talked about that, So that side of the business, I think, it's hard. But the question was specifically about the difference between the cash flow and the income statement. It's the cash flow that matters. So being free cash flow positive is what matters. I would just warn that this company is doing that, I think, because of serious questions about the debt and everything. I don't know if is there any information news about that? Let's see.
What specifically? Like what they're doing with that?
Yeah, I was just curious where there was information about the if there had been news and stuff about where the bonds trade or anything like that, but I don't see a lot of like news stories specifically about that side of it. It's just the write-offs and stuff that I can see. But
Crazy.
I would guess that that's overwhelmingly why they're doing it. They've said they're focused on free cash flow, but I think that the reason is probably related to the debt that they have.
Mm-hmm.
How much debt do they have officially?
Go to quarterly to get a updated snapshot. Let's see, short-term debt 3.7 billion, and then long-term debt 37 billion. So
Okay.
a lot.
Yeah.
Over 40
and then if we
billion.
look at the overview of the most recent time period, what have they been doing in sort of like cash flow from operations, that sort of thing, if we go to the annual?
Cash flow from operations looks like 7.5 billion. TTM is 7.9 billion.
Okay. And so before that, they were not merged together, basically, that we're seeing, not for the full year. So, I mean, that obviously is going to take out, just for the United States things, that's taking out your taxes and things like that. So it's different than if we're looking at an international company. But that is ultimately what's really available to service the debt and to pay it down if they want to pay it down over time. You don't have more than that. And their CapEx is significant when we include things, we're talking about intangible capital expenditures. But that's heavy, right? I mean, I don't think you want to be 5-6 times your cash flow from operations, what your debt is, especially if you're, lacking durability for some of your businesses. But like them writing off, say, a cable channel or something, no, it doesn't matter. It makes absolutely no difference. And so in the long run, if a company wasn't reporting net income but was reporting cash flow, yeah, that's what you want, as opposed to the opposite. It's all about the cash flow and the balance sheet that you have, not about the income statement. I'm just saying in this particular case, the reason that they're probably doing it has to do with the amount of debt that they have and their awareness of that and how they're going to deal with that. Because what do we, right now, we have the market cap at what?
18.8 billion.
Okay. So we're talking about, let's see. I mean, at face, is it 2/3 or something of their capitalization? More than that is debt, basically. If we take that, that's 40. I mean, there's 40 billion of debt that they have, and you're being told that the equity portion of that is only worth, in the market, is only worth 18 billion or something. Then they're kind of saying that this is a capital structure that's very, very heavily debt. Now, on a leverage basis, that's not that bad. If we look at cash flow again, just to see, this is what the question was. So what do we have in terms of free cash flow for the recent years?
6.1 billion and 6.7 billion on a TTM basis. Yeah.
Right. So it's trading at, say, 3 times, right? So, but even on a leverage basis, it's trading at what, 10 times? Right? If it has 6 billion in free cash flow and yet the entire enterprise value is only 60 billion or something, then it's only trading at 10 times free cash flow, which isn't bad either. Now, is the cash flow exaggerated, though? Because they're intentionally doing this because of their awareness of the debt. What is the operating profit? There's none in recent years. It's all like, because of that, it's including write-offs and stuff. Yeah. Yep. So it's probably very confusing to people to be able to analyze that and figure it out. Obviously there's lots of things that you could sell off and pay down your debt as a way of doing it instead of getting it from your cash flow. So I would care about cash flow, not reported earnings, but I'm just warning that they may be generating the cash flow they're generating right now because there's a focus on their debt situation.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. If you have a question that you would like us to go over, email to me at andrew@focuscompounding.com. If this is the first time you are tuning in with us, be sure to hit the subscribe button wherever you're listening or watching us. That helps spread the word and hack the algorithm with Focus Compounding, and it also notifies you every time we upload a podcast. If you're interested in learning about our money management services, reach out to me at andrew@focuscompounding.com. Thank you so much for tuning in with the both of us, and we will see you in the next podcast. Take care.